I'll use a property that I bought not too long ago. It was a condo. Now the play with this condo for me specifically was appreciation. And I'll talk about that in just a little bit. But for me, this condo, it was like $220,000. We put 10% down. We got a great loan opportunity on that condo. We put 10% down. Now for us, we rented that condo. It was kind of like in a college town. So we rented that condo to a bunch of students. We cash flowed about $900 a month. So our mortgage was $1,150 and we were just at the $2,000 mark in rental income. Now for us, that rental income was great. That was actually our first property that we had purchased, but that rental income was great. Now paper, so we'll kind of start with now, why people shouldn't pay taxes now on their rental income. Right now, rental real estate on paper should always be a loss. Every single year it should be a loss on paper. Not because you're losing money. You never want to go into an investment where you're losing money, but because on paper there is a cashless expense referred to as depreciation that people can utilize to offset the income and not have to pay taxes. And sometimes even receive a greater tax savings because they can utilize those losses to offset other incomes. So on paper, we were making total gross rents $24,000 a year after we deducted our mortgage interest, property taxes, insurances, the HOA fees. We were still cash flowing about $8,000 a year, right? About $9,600 a year. But because we paid $220,000 for this property, we were able to recover the cost of that asset every single year for 27 and a half years. And that deduction alone was enough to offset that $9,600 difference between our income and our expenses to make it show that we made no money on paper.